Good morning, Aiden here. Let us get you up to speed. Good morning, Aiden here. Let us get you up to speed on this shifting landscape. Today's market sentiment is appearing flat and indecisive as the daily risk score sits near neutral, representing a clear divergence from the stronger risk-on momentum we have seen over the past month, while U.S. 10-year yields have softened to 4.364%, down 2.8 basis points, providing some support for risk assets. This is being offset by geopolitical friction in the Middle East, which is driving oil prices higher and stoking inflation fears, leading to a mixed performance across major currency pairs like EUR-USD and AUD-USD. Oil is the big story right now, climbing over 2% after news broke that the US-Iran peace plan hit a major setback. This is putting pressure on global stocks, with the German DAX and Indian indices feeling the heat from higher energy costs. Gold has taken a bit of a hit, slipping toward $4,650 as traders worry about what these rising prices mean for future Fed interest rate decisions. Meanwhile, all eyes are on the upcoming U.S. inflation data to see if price pressures are truly cooling off. Biggest movers right now, ASX 200 is down. Volatility Index, U.S. oil, Brent crude oil, and NASDAQ 100 are up.
morning bid, 11 weeks and counting.
All right, how are you? Is it time? Yeah, it looks like it's time. Good morning. All right, cool. All right, let's get going. Welcome to Forex.Today, the YouTube community of more than 21, almost 22,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Let's go. Hey, my name is Wayne. Welcome to my home office. I'm a currency trader just like you. Also manage endowments, so I'm very interested in risk. I'm very interested in the broad markets, in particular stocks and the direction they go, and the direction of volatility and risk. And all of this correlates back to other assets, not just the stock market, but to currencies, to commodities, things like metals and energies, and all of that all move in a Newtonian physics kind of way, like clockwork. If the dollar is strong, then other things move in the same and opposite direction. And so we cover all that at Traders. We have all of that. We know the correlation coefficients of all these things, so not too many mysteries. What we want to do is read what the rest of the market, the institutional investors in particular, we want to read what they're doing, because they've already spent the money on their very expensive software, their very expensive employees with PhDs in quantitative physics and macroeconomics, and they've already looked at everything that you and I are looking at, and they've already made the decision of what to do in current market conditions. So we can attempt to do the same, and we have all the same data. But ultimately what we're doing with the data is not trying to figure out how to outbeat the market,
but line ourselves up with institutional investors. It's almost like, ethical insider trading. We're trying to figure out what the big traders are doing and trading along with them. And so that's where TradeRs really comes in. Forex.Today is a collaboration between TradeRs and Traders Way. Traders Way is a broker. Yep. And they are our prime broker executing our trades. Very nice. And I've worked with them and known the leadership there for over 11 years. Dude, cool. There we go. What? Yeah, strange. Sorry, I didn't notice. Yeah, sorry, I didn't notice. Sorry about that. No sound. I don't know why there wasn't sound. It's the same as it is every single day. And then today there was no sound. All right, so let me move. There we go. There we go. Yeah, so apologize. I don't know why. So let's start all over again. Let's see if this will load. I didn't update it again. No. All right, so anyways, what I was saying is, first of all, good morning. Second of all is you're going to notice a lot of updates that occurred over the weekend. Some minor, some major. Some things you're going to be very surprised with. And that makes me happy. All right, so today we're going to walk through and do our morning routine, but I'm also going to point out these new updates. Currently, right now, S&P 500 still fairly flat. VIX back above 18, which I'm not happy with. Bitcoin, 81. Gold, almost 47. It's okay. But it's down right now, and that's risk off, isn't it? Oil is up. That's risk off. Dollar is slightly strong. No need to freak out yet, but it'll probably go up later. And yields, yeah, still kind of around 4.4. So not great. Okay, markets are currently navigating a mixed geopolitical friction and central bank speculation. No major economic data prints in the last 12 hours. Mideast impasse. It's cool, right? The Australian dollar is showing some strength thanks to a hawkish stance by the RBA and positive vibes from China's latest inflation numbers. Dude, this is great, huh? Keep a close eye on the US CPI release coming up on May 12th. Dude, isn't this nice? He's getting very, very smart. He's been reading the news now 24 hours a day for about a month. And he's getting really, really good at understanding context. I mean, that's amazing, actually. All right, cool. But what I was saying is over here, we have countdown timers to our next events on YouTube or inside of TradeRs. But check this out. You log in, you get this update, and then these are the 6 currency pairs you should be focused on. There's nothing right now you should be interested in selling. There's nothing with even a slight edge. There's 22 pairs you should be ignoring and 6 that you should be focused on. And the 6 you should be focused on are long. So you're basically selling yen and selling CAD right now. Done. Okay? Dude. Isn't that great? So you log in, and on the first page, you're completely updated with what's going on and know the pairs you should be buying, the pairs you should be selling, and the pairs you should be ignoring in the first few seconds of your login. And this is free. Cool. Well, that's a nice little update. Huh? Cool. And you may notice the background is slightly darker. Just I found it to be a little glary, so I darkened the background ever so slightly. It just takes some of the glare off. You know, so there's lots of little things like that have happened over the weekend, but there's also been some pretty big updates as well. This is one of them, and I'll show you. It gets even better than that.
Euro gains capped against US dollar by weak data, ING. Turkey retail sales growth quickens in March. US dollar downside risks for DX1 as geopolitics dominate, OCB, CA.
Australian dollar stays subdued as risk aversion offsets China inflation, hawkish RBA.
Euro hovers within previous ranges amid higher oil prices, fading Fed easing hopes. Japanese yen, intervention and BOJ policy in focus, HSBC. Pound yen price forecasts. Bulls are pushing towards 214. 10 resistance area.
CAC 40 shed more than 1%.
Okay. Notice in the top left, I redesigned the spike radar for you. So in 11 hours and 4 minutes, we got retail sales out of the UK. It's redesigned so you have the timer, the previous, the expected, and 40 past releases on this. All just sitting there in our squawk box. Dude. Not bad. Our charts are beautiful. Look at the charts. Just, oh my God. So is that going to come down? I didn't know it went that high last night. Yeah. Wow. I knew it would be up, but I didn't know it was down to 98. I thought it was up to 98. Wow. That's interesting. Cool. So there's the headlines that Aiden's been reading 24 hours a day. These are just the most recent ones. Risk radar. Okay, so we need to answer the question, what are you trading today? Today, right now, it's risk off. Slightly risk off. We're generally risk on, but slightly risk off today. By today, I mean now. Cool. So let's see. Risk on, 60% of you are risk on. Okay, just realize it's not risk on now, and that when the market opens, you're going to have to look for signs to confirm your bias. But right now, your bias is unconfirmed. Risk off, that's for day traders. Currently, 1/3 of you, y'all, are risk off, and that's appropriate for today's day trading, if you will. Okay? Yeah, Zach. Yeah, I'll be at the Money Show. Yeah. I don't know when I land. I don't know. Yeah, but are we going for cigars, Zach? I hope so. I also want to go to a legit steakhouse in Dallas, like legit. Yeah. Yes. Cool. Anyone else going to meet up with me on, when did I say Saturday? Yeah. Is anyone going to meet up with me on Saturday in Dallas at the Money Show? I sent out an email and I did a post somewhere. I can't remember. Right on, Zach. Cool. So, how do we get to these conclusions? It's completely quantitative. Look at that. Just nice. Like everything filled in. Yeah, very cool. Yeah, traders I'm very happy with. We've been working and working and working on the back end, the stuff that you don't even see. and it's become so stable and robust. I'm very, very happy. It's performing very well. And index radar. You guys ready? I want to show you an improvement. I love the index radar. This is showing us in real time how currencies are moving. Oh my God. I added synthetic asset indices. So for energy, we look at Brent and WTI, obviously. For crypto, Solana, Cardano, Ethereum, Ripple, and Bitcoin. For risk, we make baskets. We start with a benchmark on VIX, and then we go to our correlation coefficient analysis on the correlation radar, and we pull from it the strongest indicators of risk on or risk off based on current correlation. So when I asked him, Aiden, to make this, he's like, okay, yeah. So he did like it what everybody else did. Rule of thumb. Oh, if VIX is down, stocks are up. And he did a couple of things on like gold and stuff. I'm like, whoa. You're guessing. He's like, I'm not guessing. These are long-term held, blah, blah, blah. Convention says, blah, whatever, that gold is always risk off and stuff like this, right? And I'm like, Aiden, and I literally cursed at him. I'm like, that's bullshit. We don't report wives' tales and rules of thumb. That's not what we do here. I said, you have the data. We have the whole correlation data of 75 different assets on how they move together, up, down, or sideways. So I built it to say, look, let's start with VIX. VIX is the measure of institutional investors hedging or not hedging. Forget that whole fear index stuff. It's hedging or not hedging. So if they're hedging, they're afraid. If they're not hedging, they're not afraid. Okay, great. So we'll use that as a benchmark. And then you tell me, Aiden, based on hundreds and hundreds and hundreds of calculations, how are the assets moving? And ignore all the ones that don't have any correlation at all. And turns out I was right, he was wrong. There's no correlation between VIX and gold right now. That's not why gold moves up and down and sideways. It's not based on risk. It's based on central banking purchases of gold, which have nothing to do with risk. It has to do with monetary policy. So he's like, oh, you're right. Gold actually has no correlation. So boom. So now we created this real-time risk sentiment basket. We look at NASDAQ, Russell, S&P, and 500. Is money going into U.S. equities or out of U.S. equities? Is money going into copper, platinum, silver, and gold, or is it coming out? What about U.S. Treasuries? Is money going into the 2-year, 30-year, the 5-year, the 3-month, the 10-year? Is money going in or is money going out right now? What about Asian equities? We look at New Zealand, Hong Kong, Shanghai, Korea, Japan, Australia. Is money going into those indices or coming out? What about Europe? Is money going into FTSE right now? What about DAX right now? Okay, money going into France? Sorry. Is money going into France? No. Okay. And so not just the currencies, but now we're looking at baskets of assets in real time. So that you can just look at this and go, money's coming out of Asian equities and going into U.S. equities. Right now, energy is the biggest mover. Okay? Right now, European stock indices are down 1% right now. And if you want to see the individual components, there they are. Oh my goodness. You can see real-time flow of capital. And for day trading, but also for swing trading and position trading. The Australian dollar is by far the best currency to be trading right now, based on our analysis of the last 30 days of Australia versus everything. Okay? Crypto is hot, 10% recovery. Okay? US equities are hot, 10% recovery over the last 30 days. Risk, look, risk, definitely risk on. Metals are up 5.5%. Energy's up 5%. European equities are down 2%. Dude, trade this, not that. Aussie dollar long. Oh my God. I hope you appreciate that we're removing all randomness out of your trading. Every single trade you make now will be based on logic and intelligence and will be lined up with institutional investors that carry you across the finish line because you're riding that wave. There's no guesswork anymore. You're always betting on the right horses. No matter if you're a day trader, swing trader, or position trader. Oh my God. Isn't that beautiful? And it's so simple, yet it's so complicated, right? It looks so simple, it's very complicated. Oh my God, right? Yeah. Thank you, Jim. Thank you. Now, I told you I was working on this, and look, it's gorgeous. Now, let's continue with the amazement. Check this out. Buy these. This is what I put on the SITREP report. Buy these. Ignore these. There's not even slight edge stuff. There's just mostly nothing to do right now in Forex. So we're calculating the differential, the delta between the two assets in real time. And just avoid them. There's no clear edge. They're not up, they're not down, they're not sideways. Statistically, you're not likely to make money. Therefore, if you're not likely to make money, you're just as likely to lose money. There's nothing. And I asked him too, I'm like, really? There's nothing bearish? And he's like, yeah, it's possible. There's nothing bearish right now. There's not even mediocrity, like maybe something's going to have a slight edge, so it'll be better than no clear edge, to a slight edge, and then maybe it'll move into bearish or bullish. But that's not even true based on our analysis right now. There's a few things that are getting close, like maybe Aussie Swissy. Oh, okay. But that's that. Look, it's just seconds now. Once again, day trading, swing trading is different, right? Now we're not just looking over the last couple of hours, but what about like the week? Have you planned out the week yet? These things are bearish. These things are bullish. These things are kind of trying to move. They're kind of there. They're not the best thing to be trading, but you should be watching these. These are the watch lists. These are the trade lists. And here's everything still with no edge whatsoever. But maybe you like this view. See? Gorgeous. And then, of course, position trades, right? This is over the last 30 days. Look at Aussie, Kiwi, Aussie, Aussie, Kiwi, Kiwi, Aussie, and you're not trading Aussie and Kiwi Dude, what the heck are you doing? Oh, Wayne, my favorite is euro dollar. What the heck are you doing? Don't trade Aussie Kiwi. They're both ripper strong, right? Like, dude, what the heck? If you're not on these, you're betting on the wrong horses. You're looking the wrong way. Okay? You can't catch the ball if you're looking the wrong way. And don't trade this stuff, dude. The worst thing in the world you could be doing right now is euro yen or CAD yen for position trading. This is stuff that can last weeks. This is the stuff that can last days. This is what's happening right now today. Isn't this awesome? And there's flags. Look, little things like this matter. There's flags. Come on. Jiminy Cricket. It's good. Cool. We have been improving our spike radar. Look at the beautiful history. We have our on the horizon coming up. Okay, I added risk here so you can see the overall risk score. We're generally risk on. And here's all the live pricing for our assets. Let's see if you'll do this correctly. And yeah, you click on that. Here is the history of retail sales out of the UK. And pound yen, if it meets forecast, is expected to drop 12 pips. Okay. So pound yen is the best one to be trading. If it beats, it only goes up 10 pips. So we know like the likely direction. And we also know that like the magnitude of this report is not that impressive. It's low volatility. At least you know. Plus now you can look at the history and the data that goes into this. 4 pages of releases. Okay? Dude, for everything? Yeah, that's the theory anyways. Okay? Here's the week ahead. Thursday. Oh my goodness, look at all the events. Thursday is a busy day. Look at UK. Look at all the UK stuff. You think you should be trading pound? Or at least watching? Yeah. And there's flags. There's flags. Come on. It's not that easy, bro. Okay, so anyways, nice, right? Nice. And there's next week, too, if you're interested. All right, so, but the main view is this, and it's epic. It's epically good. And again, all our methodology is down here. Okay, so we're expecting this to move 9 pips, low volatility. Okay, how do we expect the 9 pip move? That there's a 10 pip scalp? There's 4 pages. Okay, we've looked at 40 UK retail sales events, measured all the pound pairs, and broke them into meet, beat, or miss and then on aggregate can tell you based on 40 months of data, this will produce low volatility and you'll be lucky to scalp 10 pips out of it. I'm trying to build the best calendar in the trading and investing business. That's my goal. Now remember, 90 seconds before the event occurs, you get a giant pop-up that alerts you that it's about to happen, and then it shows you real-time currency valuations to show you when the news comes out, how the markets are reacting in real time. And so you might see strong pound going into the event. The event comes out. Now he's able to tell you the actual just a few seconds after the release. And then you might see the pound collapse or the pound spike. And you'd see it visually. Boom. And he yells out too, "It's a beat! It's a beat!" Okay? Because now then we can isolate the analysis and say, well, if it's a beat, we expect 9.7 pips to the upside. 65% of the time it went up over the last 40 months. Okay? If it was a miss, he would tell you, it's a miss, expected to drop 9.9 pips. He would tell you this. Okay? So anyways, neat. All right. Well, I might have worn you out with all the upgrades, but there's one more massive upgrade I need to show you today. I say upgrade because it was an improvement. It's an addition. But we'll get there in a bit. Okay, he's looking at all the charts, and there you go. Okay, this is just pure technical analysis. Okay. Okay. I would say mediocrity. Nice. Nice. What about our cross pairs? Looks better, huh? Nice. Look at that. What do you think? Should you put this on your to-do list? What do you think of pound CAD? Should you put that on your to-do list today? What about Kiwi CAD? Yeah. Well, we already knew today was a buy in Aussie day and a sell CAD day. We already knew that. Now, what about Euro? Maybe. Okay. Remember, we're looking at 3 trends: long-term, medium-term, short-term trends. So maybe. What about pound? Nah, pass. Euro Kiwi? Pass. Pound Kiwi? Pass for now. Okay. Doesn't look bullish to me. Okay. Once again, doesn't look bullish to me. And we have this for all our pairs. We can go through the yen pairs. Hey, Wayne, what are the yens doing? Let me see. Up, 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 up. Skip, skip. Now, this is just technically. Remember when we looked at the delta, the differentials, it even said skip this one. But maybe you'll look at it from a trend point of view, because it's actually, see, when we look at what I showed you earlier in the indices, it said trade this, not that. That's looking like the day trade view. The analysis is over the last 24 hours. So it would say over the last 24 hours, which is kind of like this, the red zone inside of the green zone, they offset each other, right? So it would say, yeah, you probably want to ignore CAD yen. Now this goes all the way back to May 8th. And you're like, well, it's only the 11th. Okay, but these are 15-minute charts. And it's just saying, well, it's generally up and down now. So trend-wise, maybe we bounce back and go back into the direction of the trend. So trend analysis shows bullishness. And what the trade this, not that indices is telling us is it's not bullish now. The trend says because the trend was in place, the probability of the object in motion staying in the motion is high. And so we would get that measurement here. Let's do this, right? CAD yen is not there. So you could keep your eyes on the prize and say, well, I'm interested in CAD yen. See, here's CAD yen over here somewhere. Okay. It's flat right now. Now you might watch it moving left, left, left. See, we organize it from bottom right to top left. So like Kiwi Swissy might turn into a trade. You want to watch CAD yen and say, as soon as you see, if at all, CAD yen pop on this list, get on it, boy. Okay, pull up your charts. It's happening. And you're like, well, I don't like watching that. Well, then watch this. It's the same thing. It's just a different view. So here's CAD yen here. Not really tradable yet. But as soon as you see it up here, then you should get on it. Okay? The conviction score, by the way, is the difference between the strong and the weak. So dollar is a little bit weak. Aussie's quite strong. But yen is way weaker than the US dollar. So that's why it's the winner chicken dinner. So your best bet right now, right now, Aussie yen, second best. Pound yen, third best. Aussie CAD. Dude, if you don't start on these three, you're not trading properly. You're going to get run over by people that know. Okay, you're betting your life savings on the three-legged donkey, not the thoroughbred. Yeah. Yeah, oil up and gold down. That is the correlation we've been seeing. If you like to eat food, you're going to have to pay more for it. There's drought conditions in much of the Midwest, but not in Canada, by the way. So you might be eating Canadian Wheaties this year. We're quite bullish on copper. And we're bearish on gold. Isn't that interesting? Okay, Forex. Aussie, 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 Aussie. Okay, pound, 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 pound. Look how strong Swissy is. Remember, the Swiss National Bank doesn't actually want that, but it's happening. But we expect all of this. You see that? So everything over in this side of the dotted line, the vertical dotted line, everything below zero, everything with a negative number, we expect it to be down. Swissy, basically -5, -5. Okay, look, -5, -4, right? We expect these assets to be down, and they are down right now. So it's long-term conviction score based on macroeconomics. And then this axis is what's the daily percentage change. It's actually happening right now in the short term. Long run, short run, everything here is supposed to be down. Okay, everything in green is supposed to be up. And the stuff that is up but is red or down and is green, which there's none, is like this score, for example, is less than 1. It's neither here nor there. This is less than 1. It's bearish, but just barely. How about this one? We expect USD CAD to be bullish, but just barely. So these are actually neutral. And thinking about it, I should probably have them say, look, if you're less than 1, plus or minus 1, these should probably be considered neutral and gray. But look at this. Everything green here is supposed to be up. Everything red here is supposed to be up. It's nearly perfect. Nearly perfect. Remember, expectations are based on things like macroeconomics, monetary policy, and seasonality. Dude. Yeah. For some reason, it's not doing the coloring over here. Okay, whatever. Nazi, though, up. Yeah. Big time. We expect it to be up. It's got a conviction score of almost 5, and it's up quite a bit. Yeah, it could be AI. I don't know. So quite a while ago, we were debating. Can you remember when we were at 65,000 on Bitcoin? Yeah, we were pretty sure. We're definitely pretty sure we're going to close above 70,000 this week. Yeah, pretty funny. My oh my WTI. Will we close above 90? Yeah, seems like we will. Look at the big move on it, too. Yeah, for sure. Fed decision, no change in June. Bank of Canada. Okay. So this is based on money being placed based on that decision, right? How much money is being invested based on no change in June by the Fed? So I got this idea of how to leverage this information for this type of analysis, let's say, of what other people are doing. How can we utilize this more? And also to build an implied tool for interest rates, because in TradeR's 1.0, we had a clunky but effective interest rate projection tool for all the central banks, major central banks around the world, right? And I started looking at the methodology for it, and I spent a lot of time talking, quote unquote, talking with the IMF that releases the World Economic Outlook. And they've changed their methodology since 1.0. And instead of predicting future interest rate decisions from central banks, because it was clunky. Like most of the time it was fine, but then if it was wrong, it was very wrong. When it was right, it was because it was pretty much a given, right? So I think they realized the mediocrity, and it certainly didn't make me happy as well. So they changed their methodology to combining, instead of future interest rates, GDP, so productivity, with inflation, CPI. And I'm like, okay, I get the rationale with that, but that's not really what I want. What I want, and what I believe you want to know, is that in the next few meetings, so the next Fed meeting, the meeting after that, the meeting after that, but also for Bank of England, ECB, RBA, okay, in the meetings in the future, what is the probability of a hike, a hold, or a cut? Okay? That's what I want to know. I don't want a combination of GDP, CPI, blah, blah, blah. Just tell me, what the heck are institutional investors doing? Because they're pretty smart. They're not watching CNBC and Bloomberg or watching YouTube gurus trying to figure out what the Fed's going to do in 3 months, in 6 months, and 9 months. No, they do the math. And I'm like, well, hell's bells. Why don't I do the math on their math? I'll do the math on their math so I can read the inside information of institutional investing, understanding, sort of like the Fed Watch tool, the changes in prices over time will tell you the implied interest rate in the mathematics. Right? So something like simple. Where's my drawing tool? I need my Epic pen. Let me get my EpiPen. So if you understand the math of finance, then you can reverse engineer people's thought processes. I'll show you 2 examples. Okay, I got my drawing tool. Okay. If you were going to do the present value of an asset, you would look at the future value or income, let's say, over, okay, 1 plus I, okay? And if you do it over time, you would do plus then the next cash flow and to I to 2 and then but anyways, this is a basic formula. What we're talking about is if you can substitute, right? And you can calculate for I. Okay? So for example, right? If you lent somebody $99 and in 1 year they pay you back $100, you can figure out what the interest rate was. That's how the bond market works. So let me show you the Fed Watch tool. So they do this for the Fed. And we love this tool, don't we? You like me talking in plural? Okay. When you look at January 27th, okay, you look at the price and you can calculate, okay, so you lend somebody $96 $1.33. Okay? That's the future, the current. Okay? Then you get paid back 100. That's the future. So now you can calculate I. What is the interest rate? And based on the prices, you can figure out, reverse engineer, what the implied interest rate will be on January 29th, 2027. 68% of these prices imply that these institutional investors making money, making loans to each other, have interest rates right here. Some have a hike, some have a cut. So we can say 68.8% chance of no cuts between now and January 29th next year. It's good to know, right? Because you see people on TV saying, oh my God, the Fed has to raise interest rates. Why? Because prices are high. Why? Because energy is high. Why? Because there's a war. And I'm like, that doesn't make any logical sense. So you see idiots on TV talking like that about the Fed has to raise interest rates. And yet, did you know 75% of the market thinks that's dumb? 75% of the institutional investors disagree. And I'm one of the 75. I'm like, that doesn't make any sense. That's not Harvard. That's Cambridge Community College. Okay? So, would you like to do this kind of math for every central bank in the world that we care about? Oh. Well, guess what? I built that for you. Are you ready to be blown away again? So now I explain the math, so you can do this yourself. I explain the math. Now just do that for the RBA. Do that for New Zealand. Do that for the Bank of England. Do that for the ECB. Do that for Canada. What's the big deal? It's just lots and lots and lots of math. Yeah. But we can do it. So let me show you how easy it is for you now. You go to Fundamentals. You go to Econ Radar. And we have a Rates Radar. Shut the back door. We're doing our calculations. We're pulling, right? Oh my God. Okay. On the left is what the Fed has done for the last year. And based on our mathematical analysis of short-term treasuries, this is our prediction of the future. Now, let me actually reiterate that more correctly. Not our projection, it's the implied market forward path, I guess is what he labeled. So we pull the history from the Federal Reserve Economic Database, and then we don't use a database anymore. We look at the forwards market. We're looking, what's the best way to say this? Short-term interest rate differentials, just like we did on the Fed Watch tool. So we can look at 3 months, 6 months, 12 months. right? And look at the differentials between, reverse calculate, and then pull out the derived interest rate that institutional investors have, are finding equilibrium with. And then from that, we can tell you what all the professional treasury and bond traders are agreeing with. This is the future interest rate of the central bank. And of course, this changes every day. Now, we don't need to know every day. So every week, we will look at the entire shape and change of the yield curve and calculate our implied monetary policy interest rate. And then we break it down. In the past, it was cut, 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 cut. Okay? We're right? May, hold. June. Isn't this neat? June. It's a hole, but a 4.6% chance of a cut right now. How about July? July 28th. 5.4% of a cut. September 15th, 4.3 hike. What the shit? What? But notice, we're calculating the hikes and the cuts, but the biggest chance of a hike this year actually is March of next year, and it's only 16% chance. So maybe you prefer to see it as a table. Whoa, what? Okay. Like, look, slight cut. Actually, this is an old version. He's not supposed to be doing this. I just want to show you, like, it's supposed to say hold or cut, hold or cut, hold or cut. But anyways. So by the end of 2027, okay, you can see here, more likely to cut. Here, slight chance of increase. But it looks like, based on our yield analysis, we're on hold. There's a 4.6% chance of a cut. We're on hold. Now, okay, that's funny, too. This is an old version. I'll have to ask why he's published the old one. Well, maybe. No, I guess he's doing it right. All right, so that's a lot of math. Okay, that's a lot of math. But you're like, but Wayne, we already have the Fed Watch tool. Okay, now you have, let it load. There's the ECB. 75% chance of a hike on June 10th. What? Oh my God. They're going to hike. ECB's going to hike. Now, again, this is our forwards calculations. It's not Aiden's prediction. Aiden is looking at the yield curve of short-term European debt and calculating the differentials and changes in the yield curve to do the reverse mathematics to calculate the implied market or market implied interest rates in the future. So it's the aggregate of tens of thousands of institutional investors globally that are trading European debt. And we can reverse engineer the implied interest rates of the ECB September 10th, 2026. The implied rate is 2.53, and that's 2 hikes from today. What? We have this for the Bank of England, the Bank of Japan, we have this for the Bank of Canada, we have this for the RBA. Bro, RBA is going to hike. They're right by May 2027. What the market is predicting is that interest rates at the RBA will be 4.66. Look at this. There's the timeline. Do you like the timeline? I mean, come on. What about the table? Oh, no, I forgot to show you this because somebody asked for this, by the way. Last week, somebody asked for this. Oh, no. This. Okay. I see what he's done. Okay, he's mixed this up a little bit. Okay, this is fine. That's what I want. Okay. Comparison. Expected to hold. Cut. Tight. Right? Raise interest rates. So now you know what their policies are. But this is what somebody asked me for the other day. Carry trades. What should they be carry trading? Noki Swissy, Aussie Swissy, USD Swissy, Pound Swissy, Kiwi Swissy, Noki Yen, Aussie Yen, USD Yen, Pound Yen. So it's organizing your carry trade basket for you. Was it you, H2O producer? Waterman. Water, good man. Okay, there you go. That was built with you in mind. So while you were out having fun this weekend, I was working my ass off. For you. Yeah. Cool. So anyways, this needs to be worked on a little bit, but I'm very happy with this. Maybe this explains why the Aussie dollar is strong. Isn't that cool? What about New Zealand? Is it the same or is it different? Oh, way different. Now, that's interesting. We have no future guidance on it. And I think it's maybe we just can't get enough New Zealand bond data, but we'll look into it. Switzerland. No forward guidance, right? Yeah, okay. So some of these we're not getting forward guidance on. What about Sweden? Nothing. All right. So we got to add that, and probably the same for Norway. All right. So we got a lot of it done. We got Yeah. So we got the Fed done, the ECB, the Bank of England, the Bank of Japan, the Bank of Canada, and the Reserve Bank of Australia, all mapped out years into the past and analyzing dozens of treasuries in the yield curve to properly show you the implied central bank interest rate at every meeting. Notice that they're not just calendars of like March, April, May, June, July, like we used to. Actually, this one is. Shoot. It's supposed to be by meeting, not by month. Well, it kind of did. June 11th, July 23rd. Okay, just didn't do it in the past. September 10th. All right, so they are by meeting. So, okay, all right, that's not quite the way I asked for it to be done, but. Now, can I get a high five for all of this stuff? These are huge upgrades and additions, like huge. So good. Oh my God. So now you can read the entire institutional market 1 year into the future and understand their implied interest rates. And of course, we don't just do it once. Every week this updates, so you will see changes or perceived or implied changes in interest rates adjust over time. So it will always update. You will always have a sense of the aggregate decision making. So if, let's just say, if 1,000 banks and pension funds and insurance companies that are buying these treasuries, when you add up thousands of them, and we assume they're smart money, we're looking at the aggregate decision that some people might be knuckleheads, some people might just be straight up wrong. But when you look at thousands, that average number is going to be probably correct. And we will track it every week to see it if it's changed based on new information. You will always know if the ECB is going to raise at the next meeting or not. And you will know that there's a 75.2% chance of a hike. Okay, 75.2% chance of a hike right now being calculated by the market. Not a maybe, a probability. I don't even agree with it, but it is what it is. Not that I agree that that's what's being priced in. I don't think the ECB should do it, or at least not for inflation. Maybe they're doing it for other reasons. But the market, 75.2% chance that they will raise at the June meeting. Done. Dude. Yeah, so we're basically doing this for every economy in the world, reading it and telling you what it means, but breaking it down by central bank meeting, not by duration. Okay, lots of math. All right. So, this is the world as we know it. Let's see. Lots of money coming out of crypto still. Very net short crypto still. So looks like money not flowing into the ETFs, or at least not the futures. Okay. Peso. Yeah, I've been buying a lot of peso. I'm not the only one staring at the sun. Let's just look at the currencies specifically. Peso, Aussie, pound. Makes sense, huh? I think those are actually some of the things that are working today. Really? Well, this is the long-term positioning of institutional investors. Okay? Aussie and pound you should own. Mexican peso, I own a lot. Well, I'm not the only knucklehead. Now, New Zealand, the market doesn't love it. They vastly prefer Aussie dollar. We've been talking about this a long time. Even though Kiwi has been strong over the last 2 or 3 weeks, according to the market, it's still kind of a dog with fleas. Like it's riding the back of its Aussie cousin, and on let's say China news, but institutions are preferring Aussie over Kiwi. There is no doubt. Well, this is all fed into Aiden. Yeah. Yeah. Cool. CAD, dog with fleas. Dollar, dog with fleas, but I'm short the dollar too. So look, I'm heavily long Aussie, heavily long peso, heavily short the USD. And even on days when, do you guys remember last week, the Japanese yen was the strongest currency because of, reintervention fears? And I said, look, I just can't buy the yen, even though I know it's the strongest. I'm like, I'm a bear on it. I'm always a bear on it. It's seasonally I'm a bear on it. I have to be a bear. And even though I recognize it's strong, I just can't buy it. Now, why do I make decisions like that? Well, I can look at it seasonally, but also reviewing institutional positioning, the entire institutional market. Remember, these are large reportable investors. The market is short the yen. Despite intervention and all that kind of stuff, yada, 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 blah, 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 the market is net short. So on days the yen is strong, I pass. And this was quite literally something I said last week. But on days in which the yen is weak, which is today, I love selling yen this time of year. Good to know, right? Now, I'm surprised the market isn't more short Swissy. The problem is when Swissy's strong, it's very strong. In a risk-off situation, it should be strong. But its interest rates are zero. So when we look at the interest rate differentials, which you now have in your rates radar, remember one of the things I added to the rates radar is your carry trade, a way to organize your carry trades. So you would be short Swissy because it's got zero interest rates. And then you'd go long high interest rates. You mean like Australia, Mexico, and Great Britain? Yeah. Wait, the whole market is in a carry trade? Uh-huh. Nothing else seems to be really happening? Yeah, that's right. Carry trades are risk on. In that situation, you would expect dollar weakness and yen weakness. Okay, well, that is happening. And Canada's a disaster. It should be strong. Sorry, Canada. It should be strong. But it ain't. Well, it is a safe haven. Swissy is a straight safe haven. Okay. But these are the, right? So anyways, yeah, we'll leave it at that. We can look at the stock indices. Institutional investors are not long. They're not long the stock market. They're long soybeans, gold, copper, silver, corn, oil, but not wheat. They're net short long term, and they sold wheat this week, or I should say last week. They added to their corn positions. Institutional investors added to their gold positions. Gold's doing nothing. Remember, we've been moving sideways around 47.50. We were at 52, so we're still 5%, right? Or not 5%, $500, 10% below our all-time highs. But there's a little bit of money going in. Okay. This is week over week, and this is long term. This is what I call stock, and this is what I call flow. Okay. How much is in the vault? What happened over the week? Did you add to what's in the vault, or did you sell some? Okay. Is more going in the vault, or is stuff coming out? So the way it looks is we were probably slightly long wheat, but for some reason, week over week, it was sold off, and now the market is net short. Soybeans, best bet. Gold, best bet. Copper, silver, WTI. See, it's all organized. Isn't that cool? You're like, well, show me Aussie, Swiss franc. I haven't checked this in a long time, so I hope it works. Aussie. Okay, the markets are long and getting longer. Swiss franc, they are net short and getting shorter. This is a great differential. 20% long versus 7% short. The Australian dollar exhibits significantly stronger institutional conviction with a long-term stock position of 20.3% compared to the Swiss franc's negative 7%. In terms of short-term momentum, the Australian dollar also shows a positive flow of 3.1%, while the Swiss franc reflects a negative flow of negative 1.6%, indicating institutional investors are actively building positions in Aussie while reducing their exposure to Swiss franc. Both the stock and the flow indicators for Aussie are aligned with a positive direction, where Swiss franc is diverging negatively, highlighting a stark contrast in market sentiment. This positioning spread strongly suggests a bullish outlook for Aussie relative to Swiss franc, indicating potential for further appreciation in the Australian dollar against the Swiss franc. Holy schnickerschnocker! And you're not trading Australian Swiss franc, you're trading euro dollar because you like it. I thought you liked making money. So anyways, oh my God. And we didn't even get to the technicals yet. I want to jump out to swing trading. Okay. You should be well on your way for swing trading. And I believe on Thursday we talked about long Aussie specifically. I think I had some trepidation with long Kiwi. I think the other thing that we've felt fairly strong about is selling CAD. I don't really know how that's doing. But here's your swing trades. Aussie CAD long, Aussie dollar long. Look at all the projections. 14 4-hour candle projections. Was that 5 days, roughly? So 5 days, there's the entire week projected. 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 Okay? Dude, can't be any more clear than that. Very bullish, very bullish, very bullish, very bullish. Neutral, very bullish, very bullish. Bullish, bullish. Bullish, bullish, very bullish. Very bearish, very bearish, very bearish, very bearish, very. Dude, son of a gun. Dude, it's so good. It's so good. These are the things you should be trading right now. This Confluence radar is looking at 75 assets on 3 time frames. And it tells you all the assets that are aligned on the 15-minute, the 4-hour, and the daily. So this updates all the time, all the time, all the time. Aussie Swissy long, Aussie CAD long, pound Aussie short, Euro Aussie short. Congruence and confluence on 3 time frames. Holy schnicker schnacker. And I can find this out of 75 charts. Actually, it's 75 times 3. Okay, 225 charts, and it takes me 1 second to analyze all 225. If you take longer than 1 second, you're not going to be competitive. Anyone using TradeRs is going to run you over like a freight train. You won't even see them coming. Boop, boop. Dude, I have to remind you, most of this is free. So I will see you in 6 hours and 50 minutes. Okay. Here's the best day trades right now. There they are. Sell the CAD, buy the Aussie, buy the pound. Dude, once again, if it takes you longer than seconds to find out what to ignore and what to trade, you're just not going to make it. So, hey, why don't you swing by traders.com? Yeah. Yeah. Yes, we have a council of investment advisors. I think we have about $1,500 to invest. We started with 50,000. I think we have 113,000 now. So we're doing great. Yeah, we're meeting at noon. I sent out an email right before this session, so you should have it to the link. But we're kicking ass. I'm going to have to start a fund for, for general population to invest, or at least accredited. Because I think we're almost to our third year, is it right? But we're getting there. Anyways, we have enough track record where I think family offices would find it very important and attractive. Because a family office wants incredibly low risk, which we've built at the CIA. And they're trying to get 6, maybe 8% return. And so if we're doing 10 to 12, and yet still address the very, very low risk profile, and say, look, if you find like 12% is too much cash, I think we can make it even more conservative. I don't know if it can. Maybe I can't. It's so conservative. But our Sharp is over 1, or at least the last time I looked. So we're not too conservative. We're almost perfect. So anyways, well, look, I'm just reading Aiden here. He's talking about the surprise interest rate hike in Norway. Yeah, it's kind of neat. The meeting coming up with Xi Jinping. Yeah, this is cool. So anyways, hey guys, no joke, as Biden would say. It's true. No joke. TradeRs, most of it's free. We have some premium features, but most of it's free. You need to be using this. I'm telling you. You need to be using this. Do I spam you? No. Do I sell your email to somebody? No. I want you to have this. I already built it. I paid for it. It's incredibly expensive to build and incredibly expensive to run. But I've already spent it, so what the heck? So use it. Please come to tradears.com and use it. Most of it's free. Some of it requires upgrades, so that's a freemium model. But you will be shocked at how much I give away for free. Shocked, like blown away. And maybe I can earn your loyalty and respect. So, peace on earth. May the pips be with you. May your profits be above average. I'll see you at